All right. This week's quick value was Nexstar Media Group, local TV broadcaster, largest one in the country. These are cheap stocks, and people have been talking about them lately. I haven't looked at them in a long, long, long time. They're cheap, and I think the chatter is around deregulation making them more attractive from an M&A standpoint. But I wanted to take a look and just get a view of the organic picture first. So before looking at the write up, this is my workbook. Let's get this out of the way. This is my workbook. So the shares are down pretty significantly since I wrote this up. Markets are getting beat up pretty good. So this is now a $4.5 billion company, maybe 4.6 billion, whatever. They've got some debt. But this is a generally very free cash flow generative company. I've got it at a little over 1 billion average per year for the last 5 years. And they've got kind of the on off cycle with political advertising. So you kind of have to take a 2+ year average when looking at earnings estimates. So this is price to free cash, right? Just market cap free cash. I mean, this is like a 4x free cash company right now. It's pretty crazy. It's like almost a 25% free cash flow yield. This is EV to free cash, right? EV to free cash, and this is levered free cash. So this isn't even really a clean look at it. So this thing is crazy cheap, but these TV broadcasters are viewed as kind of a melting ice cube, right? Because cord cutting, right? I think I've got that. I think I've got a good chart listed in here. Where is it? Here it is. Yeah, cable TV subscribers, right? It peaked in like 2010 timeframe, and it's down pretty significantly since then. They're starting to move on to like YouTube TV type streaming platforms, but I just don't know the level of exposure they've got there, and what the economics are there. Are they the same as what they're getting from a cable TV standpoint? So anyway, that's kind of the backdrop. You've got this business model where they're getting paid per subscriber from the cable distributors. They've got distribution income per based on monthly per subscriber, right? So that's the distribution side of the business, and then they get advertising, both local and national, and this can be influenced with political stuff, big events, Olympics, Super Bowl, etc. The business is roughly 50-50 between those two. And there's a grab bag of other stuff in here, like they own the CW network and TV, Food Network, cable channel. They've got some websites with visitors and whatnot. So that's the backdrop, right? This is a look at the financials since 2016. They did two pretty sizable acquisitions, one in 2017, Media General, and then one in 2019, Tribune. So really anything before 2020 isn't really a fair look at what the company is today, right? So you can see here's leverage coming up when they bought those companies, and they've since repaid a big chunk of that debt to free cash, or sorry, yeah, leverage using free cash flow is pretty reasonable. I think 5 to 6x I think is a pretty good place to be. And then they've been pouring free cash into buybacks. So share count's down a ton because of industry limitations. They can't really do M&A. So that's the thesis from here, right? People were saying, oh, okay, well, we got new FCC chair in. Well, now they can start allocating capital to acquisitions, right? So here you can see acquisitions have been basically nothing, 170 million since 2020, right? Here's the two big ones. And so all that cash has just gone into debt pay down and buybacks, right? Those are the two primary outlets right now. So, I don't know. I can't comment on. I don't even know what the upside could be meaningful, right? If the deregulation comes into the picture, but the caveat is they'll likely borrow a bunch of money to do it. So if they're levered today, then they're likely going to get more levered unless they come up with a creative deal structure using equity, right? Buy a highly levered company with equity, right? Kind of put the two balance sheets together. That might be kind of interesting. The melting ice cube argument, I haven't really seen that play out yet, right? Let me look at this. Revenue has been pretty solid the last couple of years, right? 2024 was a presidential election year, so bigger number there. And then they made a comment where is this? They made a comment on their last call about, oh, here it is. Okay, so in 2025, they expect distribution revenue to be flat. So that's positive, right? I mean, that means subscribers are still coming down, but because of their price increases that they expect on contracts, that they shouldn't see that hit yet. And then again in 2026, they've got more contract renewals, and they expect distribution revenue to be up or flat in 2026. I think that's pretty positive when you're talking about a potential melting ice cube having 2 more years before you even see that come through. I guess the flip side of that is if the pitch is that M&A is good because of operating leverage, then no M&A would be pretty bad because of the reverse operating leverage, right? So if you see that distribution revenue start declining, that would clearly be bad. Whole industry is cheap, right? And these guys, Tegna is a little less levered, but Nexstar doesn't have as much leverage as some of these peers. So some of these things are just trading at like kind of call option-y level because there's so much debt, unlike the Gray Media and Sinclair and Scripps. So yeah, it's cheap, right? It's crazy cheap. And I try to do this 5-year exercise. I said, okay, 5-year free cash. The last 5 years was about $1 billion per year, right, on average. So if you took the same approach and said, well, treat it like a melting ice cube, what goes from 1 billion on average down to 900 million or 850 or 800, et cetera, total free cash, right, during that 5-year period. Okay, well, let's say they spent, they keep debt at a constant level of free cash. I said 5x debt to free cash, right? So this is the amount of capital they'd have to put toward the debt. Okay, how much would that leave for buybacks? Great, somewhere between 20 to 50% of the market cap. So if you just said on an organic basis, average free cash over the next 5 years is going to be lower, right, than it is the past 5 years, and they keep debt in check, then that still leaves you a ton of room to buy back stock here. So I don't know. I thought that was kind of interesting. So I took a stab at trying to value the thing. And where was my target here? Let's see if I can find that. Okay. I said assume 850 million average free cash, repurchase 35% of shares. So down to 19.8 million from 30.5. That's $43 a share in free cash at that 850 million level. And this is now $150 stock. So 258 share price, right, versus 150 today. That was a 10% IRR when I worked that out, assuming you go out to that 5-year period. So now I don't know, kind of looking a little more attractive here today. And then you still get the optionality if deregulation comes into the picture and they're able to do a mega acquisition. So overall, cheap stock, secular decliner, so to speak, but haven't really seen those negative results coming through on the face of the financials. Solid free cash generator, right? $1 billion a year on average for the last 5 years. I don't know, we'll see what it is for the next 5. If they don't get M&A, I would expect them to continue paying down debt and continue buying back stock. And then if you do get M&A, then they'll probably lever up to go buy something, right? Or merge with someone with some combo of attractive structuring where they can keep leverage in check. So kind of an interesting setup, but I'm not sure what this business looks like in, call it 10 years time, as opposed to the next 3 to 5. So let me know what you think. Take a look, valuedon'tlie.com. This is quick value number 263, Nexstar Media Group. I'll try to take a look at the other broadcasters as well over the next few weeks, just to get a comparable look at others in the industry. So share your thoughts if you've looked at it.